While the rest of the market has rallied to record highs this year, the healthcare sector is flatlined, up just 3%. For more on what's weighing on the sector, let's get to Bob Pisani at the New York Stock Exchange. Hey, Bob.
Hello, Melissa. Healthcare is indeed suffering. You know, it is the worst performing sector in the S&P this year. It's up just a little more than 2%. Yikes, look at this. It's lagging way behind technology, industrials, consumer discretionary, communication services. They're up more than 20%. Healthcare is suffering, not so much because any fundamentals are deteriorating. It's mostly suffering because the sentiment is deteriorating. Sentiment has been slumping, for example, in pharmaceuticals over concerns that Democrats will put pressure on drug pricing. So the big drug names, your Bristol Myers, Pfizer, AstraZeneca, Lilly, Merck, they're down or underperforming this year. And sentiment is also deteriorating in healthcare providers like the HMOs and the Medicare and Medicaid providers like Humana, Cigna, Centene, United Health, over concerns about Medicare for All, even though the chances of passage of such a bill are slim. The House Rules Committee, however, did hold the first ever hearings on Medicare for All and single payer just this week. So here's the bottom line. This whole Medicare for All is a very low probability event, but the industry and investors seem to view it as an existential threat to the whole model. Most analysts will tell you Medicare doesn't pay the full cost for Medicare patients. They don't pay profitable rates. It's an eternal complaint. So if you outlaw private insurance, the whole healthcare system comes under severe stress. Again, it's a sentiment issue right now. Back to you, Melissa.
All right, Bob, thanks. Bob Pisani. Our next guest says the bottom may be in for healthcare, and there's two names in the space you can play for a catch-up. Let's go off the charts with Mark Newton of Newton Advisors. He's over at the plasma. Hey, Mark, what are you looking at?
Hi, Melissa. So I think healthcare can actually outperform substantially in the weeks and months to come. And so I want to show you a couple of different charts to take a look at this. As Bob Pisani said, this has been the worst performing sector this year, but yet it's actually turned in the best performance of any of the 11 major sectors of the S&P in the last week. So it's only up about 2.5% for the year, but it was up over 1% coming into today over the last 5 days. Here is the XLV versus the broader market. As you can see, we've gotten extremely oversold versus the broader market just in the last year or so. We've pulled back substantially. However, we've started to turn up pretty aggressively, and if anything, my thinking is that we really snap back and capture some of this mean reversion that should be possible during a time of very seasonally bullish seasonality for healthcare. So the bottom line is this. We have technical situation where things got very oversold. We're starting to bottom out. Seasonally, May through July represent the best months for healthcare. Over the last 5 years, they've averaged more than 1% in each of those months, May, June, and July. Third is that Biden all of a sudden now is the front runner for the Democratic Party. And as we know, he's not likely going to go towards a Medicare for all or a single payer. So if anything, my thinking is, and what we've heard is that he might tweak the Obamacare model. So the combination of those, technically very oversold at a time when the markets had 4 great months, leads me to think that near a seasonally bearish time for stocks, that healthcare should be the play. Here are two stocks that I like to really take advantage of this possible mean reversion. One is Bristol Myers. So here the stock has pulled back about 15% just from the highs in March alone. Of course, the ongoing acquisition of Celgene is going to wrap up sometime in the third quarter. Bristol beat pretty handily in earnings over the last week, and now we've started to move to the highest level we've seen in the last 10 days. So technically this has gotten oversold, quite oversold. It's dropped down from 70 down to levels in the low 40s. We've bottomed out at exactly the same levels that we saw both in last October and also in January, and now we've turned up to new weekly highs. So this is also important. So I think Bristol Myers can rally to the high 40s, and that would be one way to really play this. The other is Pfizer, and everybody knows Pfizer. You take a look at Pfizer, really, it peaked back in 1999, 2000. It's not been above that level since then. So what has it done this year? Just since last November, December, we've pulled back from levels right near in the high 30s, about 10%. So if anything, it's a very good risk reward at a time when this sector should be starting to turn higher, at a time to buy Pfizer and think this stock can move back into the low 40s. So those are two picks that I would choose for mean reversion. I like Bristol Myers and I like Pfizer. Healthcare technically definitely starting to show some signs of near-term momentum. It's going to take a lot more in the long run for this sector to turn higher, but for me, it's a great risk reward at a time when a lot of these tech stocks have gotten very overbought heading into the month of May and starting to show, revenue deceleration and this and that. So this group's really starting to show very good signs of outperformance near term.
Yeah, Mark, I happen to agree with you, Bristol-Myers notwithstanding, but I guess my pushback to play devil's advocate would be, in terms of the RSIs, these stocks could go sideways for a while, the RSIs could flatten out, and we could be in a 6-month period where they go sideways to slightly lower. Is that a possibility as well?
Well, I'm looking at a couple things. I'm looking specifically at really the next 3 to 5 weeks. And my thinking, if the market shows any sort of signs of peaking out, the pharmaceutical space in particular should offer a lot of outperformance. So on an absolute basis, though, stocks like both Bristol-Myers and Pfizer were positive today and really a bad tape. So these stocks hit new multi-day highs. So near term, I think they work. And really over the next 3 to 5 months, I also think they can outperform.
Mark, thank you. Good to see you. Mark Newton of Newton
Likewise,
Advisors. Dan Suzuki, you like healthcare here?
Yeah, I think it's a great buying opportunity. I think that both Bob and Mark are telling you the same thing. I think they're saying that they're echoing that sentiment. Bob's whole thing was about how the fundamentals are still solid for healthcare, yet this is all sentiment driven. And that's absolutely true. I think that healthcare has always been a lightning rod for political criticism. But if you look at the underlying fundamentals, they're probably some of the best in the S&P. They're one of the few sectors in the S&P that has very good estimate revision trends, sales revision trends, positive sales growth, positive earnings growth. I mean, that's a rare phenomenon to see this quarter. And if you look historically, when you at the multi-year periods of outperformance and underperformance, the number one driver of the underperformance periods, the longer secular underperformance periods, are really a function of profit cycles accelerating. So if you look at the 90s, because the reason I looked at the 90s was because everybody was talking about healthcare reform, the Clinton healthcare reform proposals. If you look at the 90s, though, the two periods of underperformance were in the early 90s and 1999. Those periods had nothing to do with healthcare reform. I mean, they were a small component of it, but the big component was that we had two profits recessions, and you had huge rebounds in profits coming out of it. That's not a good environment for healthcare. But is that the environment we're in today? No, healthcare profits today are decelerating, and that's a great time to be in healthcare, which is actually the longest, best performing sector of all time, and has cheap on every single valuation metric out there, which you can't say for any other sector out there.
I would just say simply, if you think about healthcare as having been defensive during periods where people were questioning the EPS exposure of the overall market, this is that time. Think of the move down in things like United Healthcare, and although it snapped back, that's a name actually I still would be buying on this weakness.
Well, I just mentioned one thing about the XLV because I know that Mark was charting it a little bit. I mean, it's had 10% drops in the last year, so it doesn't feel particularly defensive when you consider, I mean, that's one more than the overall market has right here. Given that defensive nature, I don't know. I mean, it seems to me that it's forming a bit of a wedge here, and there does seem to be political risk here.